Okay, guys, we're going to go ahead now and look at the practice for midterm one, practice midterm here. And I recorded this in class. The recording didn't turn out as usual. No surprise there, I guess. And so I'm just re-recording it here from home. Okay. And I'll put this up on, well, if you're seeing it, it's up on Canvas. You probably figured out under the practice midterm module. Chapter 4 we finished, and that's under Chapter 4. I re-recorded that and put that there as well because that one didn't take either. Okay, but let's take a look at these questions. Bert and Lisa are married, live in a common law state, and they want to make a gift to their 4 children. And so you've got what? You've got 2 donors and you've got 4 donees. So we can have what? An amount of $14,000 is the amount for 2017 per donee, and then that is extended to each donor. So they could make a total of $112,000 of amounts that they could give to their heirs as gifts in a single year without having to pay tax here in this example. And then there's also a lifetime exclusion that if you exclude the annual gift amount, you can take off of a lifetime exclusion, which may you ever have to exceed that. That's good news for you because those are in a range of like 5 million. And I think those amounts are going higher in the future. Okay. For the new law, it's 11 million, I think, and those will continue to go up. Okay, number 2, Mark, a single taxpayer, earned $60,000 in taxable income, $5,000 in interest from an investment in these non-taxable bonds. We want his effective rate, so we take all income, whether taxable or not. Obviously, to figure out his tax, we only pick up the portion that's taxable. And he has this amount that's over the threshold for his bracket, and so we have to take 25% of that according to the table, and that gives us this $5,512.50, and then of course we have to pick up the 5226.25, which would be applicable to anyone in that bracket. Add those two together, that's his tax divided by all of his income, whether taxable or not, gives us the marginal rate here. Okay. All right, good. Let's take a look at this next one from Chapter 2. Chapter 2, I'm not going to go too heavy on, maybe 1, maybe 2 questions from Chapter 2. Remember, that was working with the tax law. Jury trials available where? District court. Okay. You have to, if you don't want to pay the tax, you have to go to U.S. tax court, right? Okay, number 5, in which of any of the following situations may an individual be claimed as a dependent? Remember, we have the issue once we get past the qualifying child, we go down to the support category, and most close relatives can get in there, grandmothers, etc., even if they don't live with you. But when we start to get to relatives that are a little more distant out, like a cousin, they have to live with you. And of course, non-relatives, someone that you wouldn't even consider possibly being a relative, a friend or something, has to live with you. Okay, good. Then we get into number 6. And before we go too far into 6, I just wanted to go ahead and bring up the textbook for a second and point out something. I'm not sure that we made quite as much out of it as we should have in class, and that these favorable rates for the long-term gains only kick in if the taxpayer's regular rate is above these more favorable rates. Then you get to kick into these more favorable rates. Okay, and so that was something that we had talked about on Friday that I think there might have been some confusion, because I don't know that we emphasized that quite enough for it to be in your head when you would have looked at this question, okay, which is Kirby's in the 15% tax bracket, okay, and then we have these different long-term and short-term gains, and since we don't have any losses, there's no netting, so it is simply what? It is simply the short-term gain, and then we pick up this amount from the coin collection, since it would have been at 28% as the favorable, more favorable potentially more favorable rate that we looked at on that page from the book a minute ago. Then we go ahead and we'll tax it at his regular rate, which is 15%. And of course, for short term, you just use the regular rate. So that's why we put those two together. And then the 10,000, because his rate is above the more favorable rate, which is 0% for long-term gain, like on something like an investment like land, he only has to take the, he doesn't have to pay any tax on that. He gets a 0, okay? And so you see how they calculated the answer there, okay? All right, good. Let's look at number 7 now. And we have Dave, who loaned daughter Deborah $100,000 to purchase a new car to pay off her college loans. And there are no other loans between them. Relevant rate was 6%, and the loan was outstanding for the entire year. So we take a look here, and the question is, do we have to impute the interest? And we do, because we are outside of the threshold where you wouldn't have to impute the interest on that. So we go ahead and we pick up the 100,000. Okay, and the 100,000 is what? And it's 6% for half the year, and then what? And then another 6% for the back end of the year, and you calculate it semi-annually like that, and that gives you this 6090, which ended up being the answer to this question. And remember, guys, when you look at these, it's always the lender that has to impute the interest income. The idea being that they're probably trying to push that interest down to the lower taxpayer to avoid them paying the tax. So we have to impute the interest. Okay. Number 8, under the alimony rules, the income is included in gross income of the recipient of the payments, at least in the current law. I guess that's changing, where the payer will still have to include that in their income, and the recipient will not. Okay, and then going to number 9, and number 9 will be like question 16 on your exam, in which you will have to do a free response. Okay, and so we take a look, and we have this Megan, 23, is a full-time law student, claimed by her parents as a dependent during 2017, received $1,400 of interest income and income from a bank savings account, and $6,100 from the part-time job. So we'd say that her standard deduction is the greater of this 6,100, standard deduction of 6,100 plus 350 of her income, which puts her up to 6,450. Okay, and it is limited to the 6,350, which is the standard deduction. So she has what? She has the 1,400 plus the 6,100 minus, and she can only take the standard deduction here of the 6,350, even though her income plus earned income plus the 350, but it exceeded the standard deduction. And so her taxable income then is going to be her income minus her standard deduction. So you can go up to that standard deduction using the formula of net income plus the 350. Obviously, they're not going to let her take more than her standard deduction here. Okay. Okay, good. So that is pretty much what we had talked about on Friday. I mean, obviously, we got into a little more discussion with questions, etc. But unfortunately, that didn't record, and so I'm posting this up as to replace the one that didn't take. Okay, all right, guys. I'm going to put up an announcement on Canvas. You can also bring your quizzes with you. Okay, the actual quizzes that we had for chapters 1 through 4. I'm going to let you bring those. Don't print out every single test bank question. If you come in with reams and reams of paper, I'm not going to allow that. But you can come in with the 4 quizzes, and I'll put an announcement up on that, and hopefully everybody will see that. Okay, guys, we will see you on Tuesday. Hopefully you'll be ready for the test. Okay. All right. See you soon. Bye.